Good afternoon, everyone. Welcome to the research seminar series of the School of Political Science and International Studies here at the University of Queensland. It's a great pleasure to introduce our speakers, Professor Stephen Bell from Pulsis, UQ, and Dr. Feng from Griffith University. Obviously, both do not need introductions. Stephen's in our school, know Stephen very well. But also Dr. Feng, Feng has previously been a colleague at UQ. I'll just say a few words about their research. So Professor Bell has published widely on his research interest on the political economy of finance and banking, global governance, and also institutional theory. Should I add any more to that, Stephen? And I should have said that Dr. Feng is an ARC Future Fellow at Griffith, and the project is on Chinese banking Chinese currency. Stephen and Stephen have worked together previously, and their presentation today is based on a current research project on finance, Chinese finance and institutional theory. I should also add that their latest co-authored book, which came out in 2013 with Cambridge University Press, was entitled The Rise of the People's Bank of China, The Politics of Institutional Change. Is that correct? Harvard.
Yeah.
Oh, yes, that's right. My apologies, Harvard University Press. And today they will be speaking on rethinking critical juncture analysis, institutional change and the liberalization in Chinese banking and finance. So, great pleasure to have you both, and without further ado, over to you.
Thanks for coming, everyone. Can you hear me down the back? Is that okay? Yep, okay. So, this is Steve and Steve teaming up again. This is actually, well, it's a paper. It's actually kind of a synopsis of bits and pieces of a book we're writing, and we're getting towards the end of this book. And the book is actually called Banking on the Growth Models, with that subtitle, I think, isn't it? Institutional Change in Chinese Banking. So what we're doing, in a nutshell, is looking at the relationship between the Chinese economy and the Chinese so-called growth model, and the Chinese banking and financial system, and how that's evolved through time, and the politics around all that. So we're tapping into a quite recent literature, which is interesting, on growth model analysis. And that does a sort of a comparative economic analysis, and comparative capitalism is based around the contributions, the various contributions to aggregate demand in economies. The principal ones being net exports, investment, household consumption, and government expenditure. And you can actually look at the way in which countries organise themselves around those factors of economic growth. And it tells us quite a lot about different sorts of economies and what they're up to, etc. So we kind of tap into that kind of analysis. Now, pushing that into the China frame, what we get is a growth model in China which has been running essentially very strongly on investment, particularly in infrastructure, and more recently in property markets. We've also got very strong investment in the state-owned enterprise sector, the SOEs, and it's an economy at kind of one remove, which is also reliant, or has been reliant, on net exports and the kind of private FDI export sector. And the Chinese economy is quite unusual in the sense that it's running very strongly on an investment-led system dominated by the state sector, and it's running very weakly. Do we want to put some charts up there if you change that? See that the next slide. It's running really weakly on domestic consumption. So that's kind of comparative growth model analysis. And what you've got there charted is the contributions of exports compared to domestic consumption as a share of GDP. And you can kind of array different types of economies, particularly the blue ones and the red ones. And the blue ones are essentially the kind of low consumption, strong export-led economies, and the ones in red are the kind of more neoliberal, domestic, increasingly debt-fueled, consumption-based economies, which are weaker on exports but much stronger on domestic consumption, and increasingly domestic consumption based on debt. Now, China's in there too, and increasingly, unlike a number of the other export-led economies, China's actually increasingly also using high levels of debt to fund high levels of investment, etc., particularly after the global financial crisis. So that's putting kind of China into that sort of interesting recent literature. You going to do the next one, Steve? In the China case, we had this kind of quite unusual pattern. What we've got is really strong capital formation and investment growth, combined with the purple line is essentially wage repression, which is to say, we've got, unlike the US, for instance, China actually has wages growth, but wage repression is wages growth not keeping up with productivity growth. And I'm writing another book with an economist, Michael Keating, where it's actually quite a big deal, this link between wages growth and productivity growth in national economies. It tells us quite a lot about distributional conflict and inequality, etc. So in China, we've got essentially a falling wage share to GDP, and we've also got falling household consumption, which used to be earlier up around 50% of GDP, and it's actually falling. It's now around 36-37% of GDP. Now, that's not to say that consumption's falling in absolute terms, it's falling relative to GDP growth. GDP growth has been quite rapid, but this is a highly unusual pattern of economic development. And it tells us something with wage repression and household consumption repression. It tells us something about the distributional dynamics within the Chinese economy that are really significant. China now has about half the share, or a bit less than half the share of household consumption relative to GDP of the advanced economies. Australia, the US has 60, 65, 70% of GDP. So China's about half that rate. Now, I'll say more about the growth model in a minute, but the growth model is fundamentally serviced by the... no, hang on, I'll say more about the growth model first. The growth model is recognised increasingly as unsustainable. The problems are the weak domestic consumption base, which is... China's authorities recognise that this has to be boosted. China has to rely more on, in a sense, indigenous forms of economic expansion. In mature economies, that comes essentially from household consumption. China's economy is recognised globally and by the leadership as unbalanced in that sense. To boost household consumption essentially means massive forms of redistribution of income. That's the rub. The wages sector is growing, but still the inequality generated by wages repression is a problem. The other problem is the amount of capital investment and investment-led growth is way out of whack. It's an extraordinary level to get near 50% of GDP on investment growth. So this is cities that are occupied, increasingly roads and highways to nowhere, etc. Now, China does have to do a lot of capital investment, but it's excessive relative to where it is in its economic growth phase. That's a problem too. The other problem is that the export sector, after the global financial crisis of 2008, hit a wall, and the authorities in China no longer expect the export sector to play a major role, or should play a major role, in economic development and growth, because it's proven to be quite unreliable given the sluggish world economy since 2008. So there's a major question mark over the export sector as well. So there's big problems with the growth model that are recognised. The rhetoric in the last decade or half decade has been about rebalancing the Chinese economy. In 2007, before the real problems started after 2008 in China, Premier Wen in public got up and said the famous 4 uns statement. So the Chinese economy, quote, is unbalanced, unstable, uncoordinated and unsustainable. This is not a ringing endorsement from the leadership. So the leadership is well aware of the problems. Okay, so the Chinese banking and financial system is also a major problem. It's been locked in as a servant of the prevailing growth model. The system operates in a kind of slightly bizarre fashion, and the Chinese financial system has been dominated by the big four state-owned banks, which are the biggest and some of the biggest and most profitable banks in the world. They're not really banks, but they appear as banks, and their data looks like they're big and profitable, etc. The state-owned banks traditionally have relied on vast pools of deposits pouring in from myriad Chinese households that are strongly encouraged to save, because basically there's not much support with health and welfare systems. There's a strong incentive for households to save. The savings options are limited through regulation, so that really the only place to save is what was within the state-owned banks. So vast amounts of funds get poured into the state-owned banks from the essentially hard-pressed households. The interest rate system is rigged so that very low deposit rates are paid. In real terms, you're often losing money by depositing funds in the banks, and this is called financial repression. So Chinese labour and households have wage repression and financial repression, and it's a system of recycling funds from the household sector through the state-owned banks. And guess where it goes then? It goes out of the state-owned banks essentially by decree into the state-owned enterprises and funds the state-owned enterprise sector. And also to some extent the investment sector, which is primarily led by local governments, etc. This is part of a much bigger financial architecture involving a managed exchange rate system, capital controls, financial repression, etc., etc., which puts the big state-owned banks in a prime position, and the banks essentially are acting as fiscal agents to the Chinese state. So this is a statist growth model. It's a statist banking system, etc., etc., and it works in these sort of Byzantine ways. For the regime, essentially. The state-owned banks, despite looking big and profitable, are actually extremely weak and fragile. The problem, or one of the problems, is that the banks are essentially told to lend funds to the giant state-owned enterprises. Now, I can't emphasise enough how important the SOEs are in the wider Chinese system. But they are the commanding heights of the Chinese economy and remain so. And one of the reasons they remain so, despite decades of reform of the SOEs and so-called the market transition in China, is that the SOEs are essentially the key economic resource of the party and the playground and resource base of the party elite. And the place of tens of thousands of high salaried official sinecures, etc. So the SOEs are kind of the backyard of the party elite. The SOEs often don't pay back bank funds. So funding is channeled from households through the banks to the SOEs, etc., and other state enterprises. But the SOEs in particular are often not very good at paying back the money. So again, we have a bizarre banking system. So what happens every decade, on average, the state-owned banks have piled up huge amounts of non-performing loans, or NPLs. And at the end of each decade, there was a period after the Asian financial crisis when the leadership became worried about fragile banking systems in the region, looked to its own banking system and got a bit worried. There was a major attempt to restructure bad debts and stuff on the balance sheet of the banks. And this is a periodic event where the NPLs are kind of swept up, put into bad banks or asset management companies. The balance sheets of the main banks are cleansed again, and the whole process starts again. And about a decade later, you get the same kind of crisis. So the NPL problem is a really big one. Technically, by any Western accounting standards, the big four banks are insolvent most of the time, or have been historically. So lately, growth model reform has been on the agenda, and also banking reform has been on the agenda for at least 2.5 or more decades. And it was really kicked off by the Asian financial crisis. Now, the standard argument is that, and we talk about a funnel of causality, so you can think of kind of at the top, you've got the kind of Chinese status regime and all that stands for. You know, just below that you've got the growth model, the SOEs, the SOBs, the state-owned banks. You've got a whole bunch of institutions in the funnel, you know, the capital regime, the exchange rate regime, financial labour repression, all the institutions and drivers of the system. This incredibly complex and interlinked system. And down the bottom of the funnel of causality, if you like, you've got the state-owned banks, in a sense, at the bottom of the system. Now, the argument and the thinking used to be that there's no point talking about bank reform in China unless you can reform the whole system above it, you know, because it is a funnel of causality. You won't reform the banks unless you reform the growth model and the financial architecture that sits above the banks as institutions and so forth. And that's been the consensus in China scholarship. Now, we've come up with a different argument, and as I'll explain, the reform momentum won't come from the top. The reform momentum we're arguing in our book is coming from the bottom, which is the banking system itself. And the issues in the banking system that I'll describe as I go through are actually filtering back up. And the dynamics are so powerful that we're arguing that the pressures on the banking system and so forth are actually filtering back up the funnel of causality, are actually impacting on the party elite and the growth model, etc., and the whole financial system. So, sorry, I forgot to mention at the outset, I'm telling an empirical story first. This is not the way we do in the book or in the paper, but to make it easier to explain all this, you've got the empirical story first, and then I'll do theory, okay, how we're going to theorise all this. Okay.
What's that again?
The 2008 crisis, the GFC hit China. China's leadership got really worried, particularly with the collapsing export sector and the vulnerability of the Chinese growth model. It was widely recognised. Now, this could have been a moment where the leadership sees the opportunity to reform the growth model and reform the banking system, but no, and it's understandable why. It was an emergency. Something had to be done really quickly. The Chinese stimulus package that was adopted was massive, and it reflects the continuously worried state of the Chinese leadership about economic growth. So this wasn't a moment of fundamental reform, at least formally, and at least at the outset, if you like. And in fact, what happened was that you know, in a kind of a path dependency story, the old growth model and the old system was simply revved up. So you've got the old growth model of huge investments in infrastructure, in particular, ramped up and running on steroids all of a sudden, you know, in a desperate attempt to keep the economy going and surging forward. It became not an Australian-style fiscal stimulus off the budget. It became a stimulus based on debt, a massive expansion of debt, and the credit system. The surge in bank assets after 2009 to 2014-15. I don't believe this figure initially. I read this in The Economist first, and I actually got one of my RAs, who's an economist, to check the data, and we looked at it too. But the Chinese financial system, in that emergency period, increased bank assets to the size of the entire US financial system in a matter of about 4 to 5 years, from about 10 trillion to 25 trillion dollars. An incredible surge of credit. So what this is doing is simply reinforcing the status regime in China. It's reinforcing the state of and the role and function of the SOBs and the SOEs and the whole local government infrastructure game, etc. The whole thing is not only path dependent, but rockets ahead after 2008. However, a huge change occurs, which is sort of somewhat subterranean. The shadow banking system is central to our story. Now, the shadow banking system existed and has existed for decades. It's been the poor cousin of the system and regularly repressed by the authorities. So shadow banks are simply banking entities that aren't banks. And in the book we do a big discussion of the internet banking system of late, which has taken off like a bomb, and various other forms of wealth management and banking and credit formation. In the emergency, and usually in a financial crisis, the shadow system was repressed and the attention was given to the SOBs. In this case, the shadow sector wasn't repressed. So what you get after 2008 and the crisis is this weird combination, which is not actually weird at all, in China, is this combination of statism plus markets, and the shadow banks are essentially in the marketplace. You get a lot of market momentum going, particularly from cash-starved or credit-starved or ripped-off households in China, mass market, clamouring, and the private sector, particularly small and medium-sized enterprises that have habitually been excluded from the formal credit system. Like, it's very interesting, how on earth did the private sector grow in China when it's been starved of credit? It's an interesting story in itself, but that's been a major source of shadow banking demand. You've got the impact, so you've got market dynamics, you've got the impact of new technologies, particularly internet and handset technologies, driving the growth of shadow banking and internet financing, etc. Even really elaborate peer-to-peer lending schemes and platforms, all sorts of things. The Chinese are just roared into this market big time. So you've got technology, you've got market dynamics, you've got also, really importantly, you've got liberal reformers in the state. This is particularly the People's Bank of China and the China Regulatory Commission for Banking, CBRC, and various other elements of the leadership that know that the SOEs, the SOBs, the whole growth model is bad, and see the operation, tentatively at first, the operation and the opening up of the shadow banking system as we call it, their version of banking reform, quote unquote. So you get that sort of politics and dynamic going as well, and also regulatory arbitrage from the main banking system that's quite keen to start tapping into the shadow sector and start funding shadow banking activities as its method of escaping the kind of tyranny of the status regime that it's also subject to. So what you've got is explosive growth. A lot of the credit growth is I mentioned before, is actually shadow banking growth. So what happened after 2008 was essentially and inadvertently, from the authorities' perspective, the shadow banking explosion has essentially let the genie out of the bottle. There's no going back now. Now there's elements in the leadership that don't like this, that can see what's going on. There's elements, the liberal elements, and as usual in the regimes, but China's no different. You've got conservatives and statists, battling it out with the marketeers and the liberals, and it's a pitched battle over the direction of the Chinese state and what's happening in China. Now that's an old battle. It's just taken on a new intensity, particularly after 2008. So the liberals are in there, pushing in their own manner for these sorts of changes, and there's lots of resistance, etc., particularly from the state sector. Now, this is having, as I said before, this is having really big ramifications for the system, because the explosive growth of shadow credit is actually putting huge pressures, market pressures, on the state-owned banks. The state-owned banks have massively lost market share. Market share, I forget the dates, but it was around 80% of banking activity in the 80s or something, and now it's down to 40-something, low 40s. It's, the state-owned banks have lost half of their market share to the shadow sector and the non-banking sector. And this is actually also, this is the reverse funnel of causality, if you like, going up. the new credit regimes are also impacting not only on the old banking system and the old regime, by providing more credit at cheaper rates to the household sector that are bailing in big time, and also the business sector, particularly the small and medium-sized enterprises. This is actually providing credit which can help fuel the redistribution of income and household and private sector consumption, which is impacting on the old growth model as well. So this is actually helping to transform both of the big problems, in a sense, through the back door. And no one planned this. It's just happening. And we argue it's probably unstoppable. That's our prediction. This is unstoppable. And we don't know the full ramifications and entirely what sort of reactions this might elicit in the end from the regime or the Conservatives. That's all to be played out, etc. Now, do you want to put the third chart up, Steve? We won't dwell on this. We might deal with it in questions if you like, but this new system is posing interesting risks to the Chinese financial system with the rapid growth of credit, rapid growth of shadow banking, rapid growth of property market speculation. We've had gyrations in the equity markets recently which have worried the leadership. You can see there, that's just a chart of pre-crisis credit growth dynamics in the first 4 countries that have had financial crises, and then China. And you can see what China's doing in relation to the other countries. It looks, on those sort of numbers, it looks pretty alarming in terms of an economic crisis kind of story. We're actually much more sanguine than that chart would suggest about the Chinese financial system, but we can deal with that. We can deal with that later if you like. Okay, that's the empirical story. The theory story is using, not surprisingly, historical institutionalism. We see the 2008 moment as a critical juncture. And what we've got empirically in this story is dynamics of institutional stability and change. We've got lots of structure and agency. We've got lots of exogenous and endogenous change processes. We've got rapid crisis-induced change, and we've also got incremental change in institutional arrangements. Historical institutionalism arguably is badly placed to deal with all of those elements in one go. And what's happened with historical institutionalism in the way it's unfolded theoretically over time is that it's ended up with 2 different versions of the story. The first version, and still extant one, is essentially a theory about institutional rigidity and stickiness. It's got a limited account of agency. It talks a lot about institutional constraints and continuity and path dependence, etc. Out of that story, you don't get dynamics of change very much. And this particular version of HI is the one that has a theory of critical junctures. And the theory of critical junctures it presents is that essentially an exogenous shock model of institutional change. So you get, prior to a critical juncture, you get path dependency, continuity and kind of stickiness. Then you get a shock, that's the critical juncture. Then you get agency, and things can happen, And then after that critical juncture, then you go back to path dependency and stickiness. So it's a no change, no change kind of story. And there's lots of discussion about critical juncture literature, and it basically more or less fits into that kind of account. In historical institutionalist literature, there's another account which arises a critique of that model, and it's the incremental change theory that says, well, okay, what really happens in institutions is that there is agency. It's somewhat constrained in discretion, but agents will over time kind of pick away and manoeuvre their way around the rules and fathom things, and you'll get slow progressive incremental change, which can add up over time to substantial change. And this is more about agency and more about ongoing forms of change. the problem with that account is that it really doesn't say anything about critical junctures or crises because it's not part of their story, and it doesn't have much to say at all about institutional continuity or stasis either. So you can see what's happening. You've got one arm of theory going along like that, and then there's a kind of critique moment, and then another branch kind of goes off in that direction, and you end up with two, in a sense, disarticulated theories under the one banner. So you end up, in the theoretical literature, the way it's composed at the moment, you end up with all these dualisms between stability and change, between agency and structure, and between endogenous and exogenous effects. None of this is very satisfactory, obviously. My approach to all this is simply to kind of stand back theoretically and say, look, what institutional theory is really about in the end is agents inside particular institutions, and inside wider clusters of institutions and other, structural kind of big things out there. And it's all about just looking at how agents interact dialectically with the context they confront, right? So it's a thoroughly kind of process tracing historical analysis. It's driven by the empirical questions, and you've got a basic toolkit for the analysis. So I call that the agents in context approach to HI. And in a way, what it's doing is kind of pulling theory out of HI. So it doesn't start with arguments about, yes, institutions are like this, they're sticky, or yes, institutions are like this, they're kind of full of agents clamouring for change and beavering away at change, and it's all about incremental stuff. It doesn't say any of that. It just says, here's the way we can study institutions, and what we find is essentially an empirical question, And we know that institutions both feature constraint and enablement, change and stasis, all that stuff. All the stuff this case has. So you need a theory that can actually deal with all that in one go. So the argument in the book and the paper, in particular the paper, which is a theoretical thing, is about how we kind of reformulate HI. So if you use that approach, you can redefine critical juncture theory, which is to say it's imperative in this account, given its essentially historical approach, to see critical junctures as moments in a longer history. So there's a model we advocate in the paper, and that sees what happens before critical junctures as really important. It sees what happens during them as really important, and it sees what happens after them as really important. So we develop a four-phase account. So in this case, what matters is what we call antecedent conditions. In this case, what we had was an agenda of bank reform prior to 2008 that was important, and the Liberals in the regime were pushing for what they call bank reform. They'd armed themselves with Western concepts of banking, etc. It was well known what a proper banking system was like, and there was argy-bargy around bank reform prior to 2008 and all this. So there was a history of all this prior. The other antecedent condition that was crucial was that shadow banks actually existed in the Chinese regime. They were there, they were routinely repressed. This time they weren't repressed, and the system was, in a sense, ready for a transformation because of the antecedent conditions. Moving on, and this is based on another paper by Sophia, who argues that during a critical juncture it's useful to break it up into what he calls permissive conditions and productive conditions. We've got a few criticisms of that approach, but those basics are useful. In our context, the permissive conditions in this critical juncture was the shock, and obviously the shock and crisis of 2008. That was the exogenous shock that hit the system. The other permissive condition, arguably, was that the Chinese leadership decided on a stimulus package. The productive conditions following that in the critical juncture was that the stimulus wasn't going to be a fiscal stimulus, it was going to be a credit surge. Now, in a sense, the credit surge reflects the path dependency story, in a sticky kind of account, if you like. We're going to do the same as we've always done, we're just going to do more of it, because this is what we know, this is the groove, this is the path we're in, let's go. It's that sort of story. So, you know, from an exogenous shock kind of story, this shock didn't produce institutional change in the first instance. It simply reinforced the existing institutional arrangements. So it's an interesting exogenous shock or critical juncture in that sense. But, and this is another argument of the agents in context approach, too much institutional theory is focused on particular agents inside particular institutions. I think you've got to do institutional analysis by looking at the system, the whole complex of institutions that interact in a much more complicated system. In this case, what you've got is a whole bunch of institutions, particularly in this, you know, the state-owned banks, the wider financial architecture, and the shadow banks. And in a sense, what's going on here is that path dependency and resistance and stability in one bit of the system is actually encouraging shifts and transformations in the other bit of the system. See, it's like squeezing on a balloon. And that's exactly what's happening. So the productive conditions are actually what's happening is that stability in one bit is encouraging flexibility in the other bit with the expansion of the SABs. Now, this taps into another interesting literature by Kelly C, who's written quite a lot on Chinese political economy, and she's very good on developing in the Chinese context the notion that informal institutions really matter. And this is a classic case. The shadow banking system, whilst constructed in part through formal institutions, the expansion of the shadow sector is an informal institutional development, certainly as far as the leadership is concerned and the regime. It's not part of the system. This is subterranean, you know, what Kelly called back alley banking some time ago. And what we've got here is a really interesting case where informal institutional change is having a massive impact on the formal institutional system. And it's a classic Chinese workaround, you know. And the Chinese are really good at this because they live in a hierarchical system. Everything they do is in the shadow of hierarchy. And they become adept at how do you outmaneuver the hierarchy and get around the rules, you know. And this is a classic development with the shadow banking sector story. So we make quite a bit of in the paper of informal institutional change and the repercussions back on the formal system. The third bit of the analysis in terms of this phasing is what we call reproductive conditions. After the crisis, the authorities and the leadership could have clamped down on the shadow banks. They didn't. Historically, they did and had. And in this phase, post-critical juncture, the reproductive phase is really important. This is why if it hadn't have happened, we wouldn't be here talking about it now. It's still going on. And the argument is that what you've got is, in a sense, as I said before, the genie has been let out of the bottle. This is a runaway market success. The market momentum behind the growth of the shadow sector is huge. The authorities, the Liberals like it, and even the ones that are worried can't see a way out of it because there's so much pressure from the market and the business sector for credit and access to better credit deals that this is, in a sense, become the new reality in the system. So, in a sense, you've got, in the jargon, you've got a classic story of increasing returns. And this is typically a path dependency story linked back to sticky institutional theory. This is applying increasing returns and this form of path dependency to a much more flexible institutional change story with agency in the whole box and dice. And you can talk about path dependency in this context. It's not just about sticky institutional rigidity, etc. Oh, that's a pretty opportune time, isn't it? So, what we're developing theoretically, I guess, is a new version of HI institutional theory that's driving a new type of account of critical juncture analysis, which then, if you apply it to this case, to us it seems to work quite usefully in kind of explaining what's happening, and the empirics are a way of kind of teasing out critical juncture theory as well. So as usual, it's a two-way street between theory and empirics, which we find quite pleasing, I think. Alrighty, thank you. That's it.
Thank you very much, Stephen and Steve. Did you want to add anything, or you come on questions?
Just at the question stage.
Steve's going to answer all the hard questions.
Okay, so Shah.
Yeah, thanks. Very interested in this research. It touches on a lot of issues I'm interested in at the moment. So thank you very much for that. The first question is empirical. The second question is more theoretical. So the first more empirical question is, what about the pushing out of investment? You know, that's been one of the main through which the excess capacity and also the credit has been pushed out in a variety of ways. We'll hear about Belt and Road at the moment, AAAB, foreign aid, which has increased dramatically, going out, previously, all those things. So maybe that is a way of dealing with this without actually redistributing wealth in the way that you suggested, which is the way that I would look at it anyway. So what do you think about that? And the second point is, I wonder if the way that you talked about your changes to institutional theory, whether you move out of institutional theory altogether at that point, because you're saying that it's about the system of institutions, but then my question would be, okay, what drives the dynamic of that system of institutions? And I'm not entirely sure that I got that from your explanation, but I can think of things that are not institutionalism that could explain that dynamic and then could explain both change and critical juncture, but they're not institutional theory. There's something like Gramscian analysis that looks at social forces. One example, you could think of a number. I mean, that just to become. What's that?
Good old Gramsci.
Oh, one example.
I'll have a quick go at the empirical one, but Steve can I'm not sure can add to what I say. But yeah, you're right. The offshoring of the investment process is an escape route to some extent. Because and the other prior to 2008, the other big kind of outflow of capital was in the US banking sector. So there's all sorts of avenues for offshoring, which the regime is seeking to explore. The current, I would argue, the current incarnation with a focus on the real economy is a bit more useful than pumping up financial markets in the West. So that's a development. But look, the regime recognises, and just about any analyst recognises, that China just has to confront the domestic consumption and redistribution issue somehow.
Politically, so tough, isn't it?
Politically, it's a nightmare because the regime is absolutely clinging to the state sector, and to effectively redistribute and boost domestic consumption. We had lunch with Margaret Pearson the other day, where Margaret's a major China scholar, and we were talking about this is one of the key issues in Chinese politics and political economy. How can the Chinese state move forward with a reform agenda while clinging to the state sector, which politically it feels as though it has to, and will be very difficult to break that nexus. And no one has got a really clear answer to that question. But do you want to add anything to that?
It's quickly, in terms of investment, there are three channels investment. One is the first you mentioned, one belt, one road, that's foreign investment. The leadership got long-term ambitions, like, given China's now number one, number two world economy status. But in the short to medium term, there's an urge to digest the excessive domestic capacity. So that part of investments, is just for me, is a channel, to establish faked external demand for Chinese export. So that's kind of propping up Chinese economy, actually. The second component of investment is domestic public investment. And the fiscal or credit stimulus after the third year